this is the form that you normally see, right?
Yep.
So you do have options to utilize all of these boxes, right? Sometimes when I see people's taxes, they only have like maybe one or two or three boxes on here. And I'm like, if you're a business, you should be utilizing and writing off, kind of what you need. Now, let me also say this. Writing off everything is not good, not all the time, right? So let me say it like this. Every single year for your taxes is going to be different, right?
Right.
If you know that you're purchasing, you're looking to work with Madam Foster, Madam Sanina, and get a property, right? Then you know that when you come to me, we cannot come and be extra aggressive with your tax deductions, right? Because we need to keep as much money as possible. So if you're making $100,000, we need you to show that in that income, right? And so some years we may be really aggressive here, right? We may get really aggressive, but when you know that there's things that you're looking to do, whether you're looking to get a loan, whether you're looking to purchase property, whether you're looking, to actually show income and grow, then you cannot be as aggressive with your deductions. So I like to let clients know every single year is not going to be the same, right? So in this particular case, if we know you're looking to buy a property, you need to show as much income for those last 2 years. So we may not be aggressive here. This also, the Schedule C is also the only form where you can take the home office deduction. Okay. If you're a corporation like myself, I don't have the home office deduction, right? But that's part of the reason why I always had an office, why I have a physical office where people can come in, a commercial space, because that is a tax write-off and a deduction for me. So I have a small home office, but I can't write that off. Right. And so even for you, if you all have an actual location, because like Sanina, you have an actual commercial space and you have a home office just like me, you have to decide which one you want to claim if you were filing on a Schedule C. You can't do both. You can't write off both of those. You have to write off wherever you are the most. So if I'm at my commercial space the most, that's the one that I have to write off. I can't write off my home office, right? But for some of you all who are working out of your home and you are utilizing your whole home, yes, a lot of people don't take that deduction. And let me not say your whole home. Let's say an area. If you have 1,000 square foot home and maybe you have a room that's around 200 square feet, then the IRS will give you will allow you to take about 20%. The maximum that you could take on a home office deduction is 30%, right? So either you're writing off $100 of your mortgage or rent payment every month, or you're writing off $200, which would be 20%, or your maximum would be $300 at 30%. But if your mortgage, and I'm just throwing easy numbers out, right? I don't know how many mortgages are $1,000 anymore. Those was the good old days. But if your mortgage is $1,000 still, then you can write up to 30% off, but it's going to be based off of your square footage. So the example we'll use, your square footage is 200. So that's $200 every month that you get to write off for your mortgage or your rent payment, right? $2,400 for the whole year. That's a deduction that people are missing. You can also write off your light, your gas, because again, you're at home. So you need the heat, you need the light on for you to be able to work, right? So that's 20% of your ComEd bill, 20% of your people's gas bill every single month. Right.
Gotcha.
In the winter times, that adds up. My gas bill is like $300 right now, right? With the heat being on every day. So if I'm able to take 20% of that helps me again as a business owner. So, and some people used to tell me like, oh, well, you can get audited if you do certain things. Let's just be clear. With the IRS, as far as the business that you're in, the expense has to be ordinary and it has to be necessary. So in your industry, in your line of business, if it's ordinary and necessary, then that is a valid expense. And as long as you have your receipts, not just your bank statements, not just your charges, I need y'all to know that too. You need to actually take a photo of your receipt. I have a phone, I have a folder in my phone, and all of my receipts, when I'm doing meals, when I'm buying things out, or what, if I get an invoice, I'm saving that in that folder with that month. You want to save your receipts by month and by in that year. Because if you ever get audited, the IRS is going to come and pull, and they're going to say, well, we want to see what receipts you got from January or what receipts you got from September. It's not going to be a chronological order. They're going to randomly do things because they want to make sure that you're keeping up with your paperwork. And so the biggest thing that you need to remember is to maintain your receipts. And a lot of people think that, oh, my bank statement is enough. No, your bank statement is not a receipt, because your bank statement just shows that you made a charge at Home Depot. The receipt shows what you actually bought from Home Depot. That's how people get caught up. And also with the IRS, you want to make sure that you're not commingling your funds. So if you are an entrepreneur, you have to have a business account and you have to have a personal account. You should not be running everything, your business, your real estate company, all through your personal account. That's the easiest way to get audited and to not pass an audit, because you're commingling funds. So if you pull up a bank statement and everything is mixed in, you automatically are done with that audit. Okay, you're going to owe all of those funds, because now they can't determine what really was business. The other thing I wanted to show you was the Schedule E. Okay. So some of you
before we go into the Schedule E, Madam Patrice, we got
I'm sorry.
April asked, what was that app that you're using for the receipt? The receipt folder app.
So I personally use QuickBooks, right? Okay. So as far as your accounting system may or may not offer different things. But when I was saying that, I don't have an actual app. I was saying in my phone, in Photos. Okay. In your actual Photos, you can create folders. So in my actual Photos, I have folders, right? And so because I don't want to keep paperwork all year. So if you don't want to keep the paper, you need to at least scan it in, have a photo of it, scan it in or something, so that way you don't have to keep the formal paper, but you have an actual record of the receipt, if that makes sense. But yeah, that was just my regular photos that I was saying about that, April, for the folder.
Gotcha.
Okay, that was the other one. The Schedule E. Yep. For the Schedule E. So I wanted you all, because again, I have a lot of clients that come to me. I'm like, do you have property? And they're like, yeah, but I'm not claiming it. And I'm like, why? They're scared to claim the property because they don't want to claim the income. But what they were missing, again, when you talk to a professional, what they were missing was, you may have made $24,000 in rent payments, but guess what? You also have all of these expenses that you're able to write off because you have this business, because you have this rental property. So because this person may have made $24,000, right? But if you had to pay $10,000 in insurance, guess what? Now that's a $10,000 deduction on this line item. If you had legal and professional fees, you had to pay your attorney. You had to pay Jacob to come in and do some things for you. Maybe he charged you $2,500. Now that's $12,500 that you're writing off, right? Again, repairs, taxes, if you're paying interest, if you're paying insurance, everyone has insurance on their property, right? If you're paying a property management company, right? All of this is a part of your expense for managing and maintaining this real estate property. And we haven't even included the depreciation. So the depreciation is a whole nother other form that when you have real estate, you get to depreciate that property for 27.5 years. Okay. 27.5 years. All right, you all. That's a huge deduction. I mean, on average, some of my clients, we have seen $10,000, $50,000 as a tax deduction on depreciating their property. And again, you're able to do this depreciation every single year, as long as you own that property, up to 27.5 years. So this is another reason why a lot of people get into real estate, because of the different advantages and the different tax strategies that you can utilize between myself and Jacob. It's just, it becomes broader for people to be able to save their money. right? And ultimately, that's what we're all trying to do. The more money we make, we're not trying to pay the IRS unnecessarily when they have all of these different things in the laws that say, hey, business,
Mhm.
you get to deduct this. But again, we're so used to being consumers and just filing our personal taxes, we don't think about the advantages of having these businesses and how much really business business has the best tax laws and deductions across this country, point blank, period. You don't get much with a single family home, right? When you buy your single family home, you can only write off your interest and your taxes. That's it.
Mhm.
If you rehab your kitchen, the IRS is not giving you a credit for that because that's your dwelling. They consider that you'll get that when you actually sell the home,
Okay.
right? But that is the reason why I set up my property. Well, I set up my real estate management company and I purchased my family house under my LLC. And the reason why I did that was, again, because I was able to get bigger and better deductions purchasing that property under a company versus purchasing it individually and only being able to write off the taxes and the interest. When I bought it under my LLC, I had this. Okay. You don't, I had this, but then I also had the business parts to this. So you can use this as a personal individual on a a Schedule E. If you have your personal, I'm sorry, not personal. This is only for rental property, right? And that's what I'm saying. If you're buying property and it's your personal use and you're not using it as the business, you're not getting the full write-offs and deductions that you really could be. And this is for every property you have. So you can take depreciation on, if you have 3 properties, you'll have a Schedule E for each
Each
property.
property.
Yes,
Mhm.
that's how people are winning, right? A lot of people don't like Trump, but I like to always use his taxes because Trump had over 500 S corporations on his tax return. Okay, let's be clear.